Good afternoon, everyone, and welcome to the latest series in the Taxation and Superannuation Updates webinars at Vincents. My name is Griffiths. I'm the Director of Superannuation Consulting here at Vincents, and joining me is Katrina Brennan, one of the managers in our Taxation and Business Solutions area. So this afternoon, for the next hour or so, we'll go through the latest taxation and superannuation updates in the last little while since we've done one of these webinar series, so that we can be up to date as to the going on in those relevant areas. So with that, I'll hand over to Katrina to talk about all the taxation updates in the past little while.
Good afternoon, everyone. I'll start off with a couple of housekeeping items, just discussing changes to thresholds. The company tax rate for the 2015-16 year sets out that the rates of notes a change of 28.5% rate for small business entities for income years beginning on or after the 1st of July 2015. Also, just touching on the CPI December quarter 2015 indexation factor for FBT purposes, as the March quarter does not actually come available until the end of April. The CPI December quarter rises 0.4%. The latest Australian Bureau of Statistics figures show the consumer price index rose 0.4% in the December quarter 2015, following a rise of 0.5% in the September quarter 2015. The CPI rose 1.7% through the year to the December quarter 2015, following a rise of 1.5% through the year to the September quarter 2015. Just touching on the private health insurance rebate income thresholds, eligibility for the private health insurance rebate is income tested against the PHI income thresholds, which are normally adjusted annually. From 1st of July 2015, the income thresholds used to calculate the PHI rebate and the Medicare levy surcharge will remain at the 2015 level for 3 years. That is, the income thresholds will remain at the 2015 level for the 16, 17 and 18 years. The rebate amounts will continue to be adjusted annually on the 1st of April based on the rebate adjustment factor, and the rebate adjustment factor for 2016 is 0.963. Insured lifestyle assets, Centrelink and Medicare, the ATO is doing some data matching. The ATO has announced it will acquire details of insurance policies for certain classes of assets, including marine vessels, enthusiast motor vehicles, thoroughbred horses, fine art and aircraft, where the value exceeds the nominated thresholds for the 14 and 15 financial years. The ATO said it will obtain policyholder identification details and insurance policy details. The data matching program will assist the ATO with profiling taxpayers, identifying possible tax compliance issues, and identifying avenues available to assist in debt management activities. It is estimated that records of more than 100,000 insurance policies will be obtained. The ATO has also announced that it will acquire details of individuals in receipt of Family Tax Benefit Part B, paid parental leave, care allowance and Medicare entitlement statements from the Department of Human Services for the 15, 16 and 17 financial years. Among other things, the ATO said the data matching program will assist. It is to ensure that taxpayers are correctly claiming entitlement to the invalid and invalid carer tax offset and the exemption from payment of the Medicare levy and Medicare levy surcharge. Just touching on work-related car expenses, new legislation proposes to reduce the number of methods by removing the 12% of original value method and the 1/3 of actual expenses method. The other two methods, the cents per kilometre method and the logbook method, would be retained. Further, the cents per kilometre method is also being standardised by replacing the 3 current rates based on engine size with one rate set at 66 cents per kilometre, which applies to all motor vehicles irrespective of engine size. Another ATO update was foreign resident CGT withholding payments. The ATO forms have been updated. The ATO noted recent legislative amendments to introduce a 10% non-final withholding on payments made to foreign residents under contracts entered into on or after the 1st of July 2016 to dispose of certain taxable Australian property. The ATO said the following forms will be made available on the ATO website as at the 30th of June 2016. A clearance certificate application for Australian residents, variation application for foreign residents and other parties, and a purchaser payment notification. Next update is the accessibility of retiring partners' interest in partnership net income. A taxation determination 2015/19 was issued on the 7th of October 2015, providing that where a retiring partner receives an amount representing her or his individual interest in the partnership net income, that amount is accessible under Section 92 of the ITAA 1936. In the Commissioner's view, this is the case even if the partner retires before the end of the income year or the payment is received in a subsequent year. Reporting offshore to offshore supply of goods. So just in relation to activity statements, when completing your activity statement, the ATO is stating do not include supplies where goods are delivered from a place outside the indirect tax zone to another place outside the indirect tax zone. These supplies are outside the scope of the GST Act. The ATO collect and share data with a number of external sources, including the Department of Immigration and Border Protection, and compare this to the amounts reported on your activity statement and tax returns. If you include offshore to offshore supplies of goods, it creates a discrepancy and may result in you being chosen for an ATO review. The ACNC puts thousands of charities on notice. The Australian Charities and Not-for-Profits Commission has issued a notice of intention to revoke close to 200 charities that it believes are no longer operating. Despite multiple attempts, the ACNC said it has not been able to reach these charities during its nearly 3 years of operation of letters, emails have bounced and phone numbers have been disconnected. So the ACNC Commissioner Susan Pascoe said revocation was necessary in order to maintain the integrity of the charity register. So they have warned that a further 8,000 charities that will soon be at risk if they don't submit any overdue reporting. Thousands of charities are nearly a year overdue with their 2014 annual information statement outstanding. Just touching on some various updates, the zone tax offset proposes to amend the ITAA 1936 to ensure that the zone tax offset is appropriately targeted to people genuinely living in the designated geographical zones by limiting access to the zone tax offset to those people whose usual place of residence is within a zone. This will take effect in the 15-16 year of income and later years of income. The ATO has reminded tax agents and the clients that there are time limits for amending activity statements. If taxpayers need to amend their activity statements, they need to make sure it's done before it's too late. An assessment may be amended an unlimited number of times within 4 years after the day the activity statement is first lodged. And also just making note that the FBT otherwise deductible rule, the ATO has withdrawn the ID 2001-304. The ATO said the ID is withdrawn because it contains a view in respect of a provision that does not apply after 30 June 2008. Despite its withdrawal, the ATO said the ID continues to be presidential ATO view in respect of decisions up to and including 30 June 2008. Some family tax benefit changes. The social services legislation amendment introduced that the bill proposes the following amendments. Family tax benefit Part A fortnightly rates will be increased by $10.08 for each FTB child in the family aged up to 19. An equivalent rate increase of around $10.44 per fortnight will apply to youth allowance and disability support, pension recipients under aged 18 and living at home. These increases will apply from 1st July 2018. From 1st July 2016, the bill will introduce a new rate structure for family tax benefit Part B and make other amendments to the rules for Part B to, among other things, increase the standard rate by $1,000 per year for families with a youngest child aged under 1. Fuel tax credits, ineligible fuels and activities. These include aviation fuels, aviation gasoline and aviation kerosene, biodiesel or fuel ethanol, unless they are part of a blend with another fuel, non-transport gaseous fuels. Non-transport gaseous fuels were eligible for some activities before 1st of July 2014. Additives, for example, diesel exhaust fluids, are not taxable fuels and have no excise or custom duties paid on them. Therefore, you are unable to claim fuel tax credits for these types of additives used in your vehicle. Deductibility of legal expenses under Section 8 proposed ATO public ruling. The ATO has announced that it will review various ATO products on the deductibility of legal expenses with a view to consolidating them into a single principles-based public ruling. The ATO added the binding nature of the eventual ruling will also give taxpayers certainty. The ATO has listed Taxation Ruling IT 149 and various other ATO IDs. The ATO said that at this early stage it was scoping the proposed new tax ruling and sought stakeholder views on this, but should cover any additional circumstances, the potential consequences of amalgamating the listed ATO IDs, and which practical factors make it difficult to apportion costs between deductible and non-deductible legal expenses. The employee share scheme, unlisted options, the ATO ID has been withdrawn. The ATO on the 30th of October 2015 withdrew ATO ID 2012/68, employee share scheme, unlisted options to acquire shares in a company not acquired at a discount. The ATO says the ID is withdrawn because it contains an ATO view in respect of a provision that does not apply after the 2015 income year. Despite its withdrawal, the ATO says the ID continues to be a presidential ATO view in respect of decisions for income years up to and including the 2015 year. Another update or proposed guidance and ruling from the ATO is claiming website costs. To claim an outright deduction for some ongoing expenses associated with running and maintaining a website, example domain name, registration fees, and service hosting costs, the ATO says it is also developing a public ruling on the deductibility of website development costs. It is consulting with tax and industry representatives to discuss the issues and scope of the ruling. It adds that more detailed information will be available after the public ruling has been developed. Another update is accelerated depreciation, just a reminder for primary producers. From the 12th of May 2015, the primary producers can immediately deduct the costs of fencing. This was previously deducted over a period of up to 30 years. Water facilities, this was previously deducted over 3 years. They can also deduct the cost of fodder storage assets over 3 years instead of over a period of up to 50. And primary producers who are small businesses are also eligible to claim the instant asset write-off until 30 June 2017. Another major ATO update has been the small business income tax offset. From the 2015-16 income year, an individual is entitled to claim a tax offset on the tax payable on the portion of their income that is from net small business income from sole trading activities, share of net small business income from a partnership or trust. The offset is applied against tax payable on business income. Essential feature of the small business offset is it applies to small business entities with an aggregated turnover of less than 2 million. The offset is only available to individuals, not in a trustee capacity who are a small business or partner or beneficiary. The income tax offset can reduce the tax payable that relates to the individual's small business income by 5% up to $1,000 each year. So there's a few more further qualifications. Net capital gains and personal services income need to be taken into consideration. The offset is not precluded from applying to Australian sourced income of a foreign resident. And there are limitations on offset availability to minors. Another one is the small business restructure rollover. So from the 1st of July 2016, small businesses will be able to change the legal structure of their businesses without incurring any income tax liability when active assets are transferred by one entity to another. So it provides greater flexibility for small business owners to change the legal structure of their business by allowing them to defer gains or losses that would otherwise be realised when business assets are transferred from one entity to another. It provides a small business with a new rollover for gains and losses arising from the transfer of active assets that are CGT assets, trading stock, revenue assets, and or depreciating assets between entities as part of a genuine restructure of an ongoing business. It applies to transfers that do not result in a change in the ultimate economic ownership of the assets. Is in addition to rollovers currently available where an individual trustee or partner in a partnership transfers assets to or creates assets in a company in the course of restructuring their business. And it extends the relief to include transfer of trading stock, revenue assets and depreciating assets. So these changes will apply to transfers occurring on or after the 1st of July 2016. Now back to a tax offset. The zone tax offset exclude fly-in, fly-out. In the 2015-16 year, the government announced that it will exclude fly-in, fly-out and drive-in, drive-out FIFO workers from the zone tax offset where their normal residence is not within a zone. Currently, to be eligible for the zone tax offset, a taxpayer must reside or work in a specified remote area for more than 183 days in the income year. The offset recognises the isolation, uncongenial climate and high cost of living associated with living in identified locations. So this measure will better target the offset to taxpayers who have taken up genuine residence within the zones. It will take effect from the 1st of July 2015. Just a couple of tax changes in relation to fringe benefits tax and work-related devices. From the 1st of April 2016, small businesses will not incur a fringe benefits tax liability if they provide their employees multiple work-related portable electronic devices that have similar functions. These include devices that are primarily used for work, such as laptops, tablets, calculators, GPS navigation receivers and mobile phones. This benefit may, in addition to or part of the employee's salary or wages package. Exempting private companies from public tax disclosure. This bill has now been passed, so it effectively awaits royal assent. It will exempt private companies from the public disclosure of information by the Commissioner under the income tax transparency laws. Those disclosure laws apply to corporate tax entities that report 100 million or more in total income. So the passage of the bill means that the Commissioner will not publish the tax information of Australian-owned private companies. The exemption will only be available to companies that satisfy all of the following conditions. The company must be a resident private company. The company must not be a wholly owned subsidiary of a foreign corporate group. The Commissioner would, however, continue to publish tax information pertaining to other corporate tax entities. And the company must not have a level of foreign shareholding greater than 50%. Another ATO data matching is eBay online sellers. The ATO on October the 8th, 2015 issued a gazette announcing that they were acquiring online selling data relating to registrants who sold goods and services to a value of $10,000 or more during the period 1st of July 2014 to 30 June 2015. So the data requested will include information that will enable the ATO to match online selling accounts to a taxpayer, including their name, their address, contact information, and the transactions processed for each online selling account. So these records will be electronically matched with certain sections of the ATO data holdings to identify non-compliance with registration, lodgement, reporting, and payment obligations under taxation laws. It is estimated that records relating to between 15,000 and 25,000 individuals will be matched. Just a few tax incentives that they have been discussing that could be brought in for business incentive measures. In discussion has been new tax breaks for early stage investors in innovative startups, an introduction of a 10% non-refundable tax offset for capital invested in early stage venture capital limited partnerships. There is a thought of maybe relaxing the same business test that denies tax losses if a company changes its business activities. Removal of rules that limit depreciation deductions for some intangible assets, and a limit on the requirement for disclosure documents given to employees under an employee share scheme to be made available to the public. I just wanted to touch on the ATO target list for the 2015-16 year. So large business ATO target areas and the GST cross-border transactions. So the ATO has revealed its compliance focus areas for large business for the 15-16 year. The ATO said it will focus on the following behaviours and choices and transactions and issues. We have the integrity of business systems for GST, GST compliance on property transactions, financial supplies apportionment for GST, compliance with new measures effective from July 17 for GST on imported low-value goods and digital products and services, GST on cross-border transactions, compliance with excise, wine equalisation tax and luxury car tax obligations, internationals and profit shifting, particularly the application of thin capitalisation rules, offshore hub arrangements and cross-border related party financing arrangements, trust schemes and arrangements that seek to minimise tax, any restructure events that may take place during the year, complex structures used by wealthy individuals and their private groups, research and development claims in general, correct application of the consolidation regime, exploration expenditure deductions and bank branch attribution, and privatisation and public infrastructure transactions.
Thanks for that, Katrina. So working through some of the updates in the superannuation world over the past little while, I suppose as some regular listeners of our webinar series may be aware, I'm actually fond of a big stat. Now, the ATO has recently issued or released their annual overview of their statistics for the 2014 financial year. This is 13 to 14. So from a high level, and within the slides that you'll receive, there's a hyperlink there. So if you really want to nerd out and have a read of the stats, then certainly by all means. I find them fascinating. But as part of that, the tax office have produced a one-page, what's called an infographic. So it's where they do pretty pictures about the details. So what I've done here is I have borrowed this from the tax office's publication. And essentially what you can see there is that on average, 36,000 self-managed super funds are established each year. And that essentially, the self-managed industry makes up just under 30% of the overall superannuation savings pool that we have in Australia. And for the 14-year, self-managed super funds returned on average about 9.8%, so just under that 10% barrier. And then the top 5 asset classes that make up 84% of all self-managed super funds. So 32% listed shares, 27% cash and term deposits, and then 11% non-residential, 9% unlisted trusts, and 5% other managed. So those last two are essentially managed funds. Now, what you may be interested to note is that residential property is not there. So that essentially means that under 5% of all self-managed funds have residential property inside their portfolio mix. Now, moving on to a topic that is rearing its head very quickly, and unfortunately a lot of accountants may be hoping that it doesn't happen. So the accountant licensing exemption will essentially end from 1 July 2016. So what that means is that accountants either need to obtain a special type of limited license from ASIC, and that license allows an accountant to talk about a class of product. So a class of product is, say, superannuation, but you can't talk about specific details within superannuation. They could talk about shares, but you couldn't talk about particular types of shares. Or you could actually become an authorised representative under Australian Financial Services Licensee, in which you provide the advice under. And there's all different types of layers of that. So you can have general advice or personal advice. So general advice is essentially where it's more factual in nature and you're just saying this is how it is, but we haven't considered your personal circumstances. And personal advice is obviously where you are considering the individual's personal circumstances and giving the advice. So up until 1 July, or currently, accountants can only provide advice in self-managed super funds insofar as establishing and winding up of self-managed funds, and also some particular sort of structuring in between. Or if it is tax advice, then that's a carve-out as well, essentially. From 1 July 16, accountants will have to actually be licensed to provide advice on basically a product. Now, superannuation is a product, as is self-managed super funds. Now, just recently, in fact, on the 5th of April, the Australian Financial Review ran an article, and this, which I must admit I took a little bit of umbrance to, because this was the first paragraph of the article. It said that fewer than 400 accountants in Australia will be licensed to provide self-managed super fund advice from July, which is just over 1% of the number who were advising in this area a couple of years ago. Now, firstly, what that doesn't take into account is that those accountants who are already licensed. So for myself, I've been licensed since 2004 to provide advice in superannuation. So this factual misstatement is essentially based on ASIC only having received 494 limited licence applications, of which only 100 have been approved. And 194, I think it was, have been rejected. So that means that the accountant has had to go away and redo some things and resubmit their application. So most accountants, I believe, are essentially going to be going the authorised representative route. And to, I suppose, support that theory, there's a number of businesses that have been established that allow accountants to give advice for self-managed super funds under their licence. So that's where an accountant can provide advice on self-managed super funds, and only self-managed super funds, for their particular circumstances under someone else's licence. Now, The importance of all this is that ASIC have quite clearly articulated that there is no proposal to extend the 30 June cutoff for these arrangements, and they've also said that there'll be no leniency shown from 1 July. So in other words, they will be looking for accountants who are not doing the right thing, I would suggest early in July, to basically set a precedent. Now, to give you guys an example of what we're doing here at Vincents, we're having some 20 staff from our taxation and tax and business solutions area. So that includes the directors and managers. We'll actually have a diploma of financial services by 30 June. They will also be an authorised representative of an entity that we have here at Vincents called Vincents Financial Advisory. So that means that we will be able to provide advice in relation to self-managed super funds as well as other products. Now, whether that advice is actually given to you by your normal Vincents advisor, that probably won't be the case. However, we have structures and procedures in place that advice can be provided to you so that you are actually getting the most accurate information in the best possible format. However, you'll be able to have conversations with your normal advisors in relation to a range of different areas. So not only self-managed super funds, but also other areas of ASIC product as well. Just a quick mention about the ATO's 2016-17 compliance agenda. So once again, related party transactions are at the top of the pops as far as what the tax office will be looking at. So they've made comments that we should expect to see more guidance and taxpayer alerts on schemes that they're uncovering. So as they undertake audits, they will essentially be releasing TAs, so the taxpayer alerts, or more practice guidance statements on things that they're uncovering to provide more guidance to the industry within itself. Limited recourse borrowing arrangements is also another focus point. Once again, no surprises there, especially those involving related parties, which is a topic I'll touch on in a minute. Also, what is interesting is that with the breadth and depth of the ATO's statistical analysis that they can undertake now, they're also going to be looking for extraordinary or out-of-pattern growth in the value of a self-managed super fund, because they consider that this is likely to mean that there is a situation where either a non-arm's length transaction is occurring or that tax avoidance is occurring. So if, for argument's sake, you happen to buy some options in a particular company that go through the roof and you make a lot of money on it, and that has a material impact on the value of the fund, you may want to expect a knock on the door from the tax office, even though all you've done is essentially performed really well, because the tax office may consider that something that raises the risk profile of the fund from basically a low to a medium review requirement. And also exempt current pension income. So the requirements for an accountant to obtain an actuarial certificate when claiming exempt current pension income, the tax office will again be looking at those situations to ensure that the right amount of tax is paid. Also remembering that exempt current pension income does not apply to concessional contributions made into a super fund, nor does it apply to non-arm's length income. Another topic I'll touch on in a minute. So related party limited recourse borrowing arrangements. Now, a little bit of history and backstory to all this is that the ATO issued rulings in late 2014 about what they considered to be non-arm's length related party borrowings. And previously, even before that, in front of the National Tax Liaison Group, which is like a little group of accountants and industry bodies and the ATO that get together and chat about different things, they spoke about the ability for a related party to lend to a super fund at a zero interest rate. And the tax office said, yep, look, that's fine, because the interest rate is at a zero rate, so therefore the super fund is not adversely affected. So once the ATO had put that statement out there, they then that became, I suppose, a popular strategy that some were using. So then the ATO tried to backpedal reasonably quickly, and in February 2014, they then started rejecting private binding rulings or making them essentially not factual or not accurately answering the response in relation to the information that was put forward. So then late 14, they issued the rulings saying that while you can have zero interest rate, other things need to apply. And then in late 2015, the IDs 2015, 27 and 28 were issued. Now 27 relates to property and 28 relates to shares. And that threw up this notion of possible, it was possible for non-arm's length income or NALI to arise in relation to an asset purchase where borrowed funds were not on commercial terms. And I just used that rather generic, vague wording, commercial terms. So then, of course, the industry said, well, what do you consider to be commercial terms? Because anyone who's had experience with this will know that every bank will have different arrangements, will have different interest rates, different requirements that you have to meet. So clearly it was more than just an interest rate. There had to be more to it. So last week, the ATO issued Practical Compliance Guide 2016/5. So this guide simply explains what the ATO consider to be what an arm's length transaction would look like. And with inside that ruling, or that guidance I should say, they've provided two examples. One which relates to property and one which relates to shares and listed trusts. Now, important to note that these compliance guidelines, they're not binding on the ATO. They can change their mind at any point in time. However, it would be a bit of a bad look if they put a publication like this out and then basically went against it. Now, what they've essentially come up with is this notion of safe harbour. So basically they've said if you comply with these particular requirements, so in other words you mimic what is in the PCG, then the ATO will essentially conclude that NALI doesn't apply just because it's from a related party or from a non-bank lender. And that non-bank lender is an important term too. Because essentially, the ATO will look at every arrangement as if it is a non-arm's length arrangement unless you can distinctively prove otherwise. So if you have an arrangement that falls within the safe harbour guidelines, then you'll be fine. You don't need to do anything. If it falls outside the guidelines, then you need to look at, okay, who was actually lending the money? Was it a bank? If it was a bank, then that's fine, because obviously that's going to meet a commercial terms. If it was a company that specialises or deals with lending money to other people, then that's fine. If it's your friend from next door, or your neighbour from next door, or one of your related entities, then that becomes a different criteria that you need to essentially justify why those terms are arm's length. So what do the ATO consider to be arm's length? So I've got some little tables here that I'll just quickly run through. So basically for real property asset, the interest rate, the ATO say that it has to be the RBA indicator rates for banks, which at the moment is 5.75%. Now the interest rate can be fixed or variable, and if it's fixed, it can only be for up to 5 years. Listed shares, same as the property, except the interest rate has to be plus 2%, and you can only fix for up to 3 years. As far as the term of the loan goes, maximum of 15 years, which I consider a little bit interesting given the fact that a lot of residential loans are for 25 years if you go via a bank. And that is from the commencement of the arrangement. So if you were to refinance 10 years after you undertake the original borrowing, then you can only have a term for 5 years. So what that would mean is you would actually need to go to a bank and ask them to refinance that way, rather than refinancing from either a related party or a non-bank institution. With shares and listed unit trusts, can only do it for a maximum of 7 years. Multiple loans are okay. So that's a situation where, say, you might have a bank that lends money to the super fund, and then you have a related party lend in as well. However, the overall LVR has to be met. So it's not just each loan LVR, it's a cumulative LVR. So 70% for that aggregate test. So interestingly, the LVR is determined at the commencement of the arrangement, or when refinancing, or at 1 July 2015. So there's a couple of trigger points there in which you can almost cherry pick as to how you calculate that loan to value ratio. So for properties it's 70%, and for shares and listed trusts it's 50%. You need to have a loan agreement, no surprises there. They also want to have security in place, so a registered mortgage or a registered charge. Now, for shares, that may be a little bit more tricky to do, because it's not that easy to have a related party arrangement in which you have a registered charge. Personal guarantees are not required. However, repayments are expected to be monthly principal and interest. So no more accumulating interest until the end of the term of the loan and those type of arrangements. So what should essentially happen? Review any non-bank LRBA arrangements that you have in place. If they don't meet the safe harbour guidelines, then you've got some options. The first option is to change the terms so they are consistent with the PCG. Obviously end the arrangement, or refinance to a commercial lender. Now, I should also probably throw in another one there as well, which is essentially not do anything. So what does it mean if you have a LRBA that doesn't meet these safe harbour requirements, or that is classified as non-arm's length income? So what that really means is the income generated by the property will be considered to be taxed at top marginal tax rate, so 47%. Now, given the fact that residential properties, for argument's sake, are only yielding about 2 or 3% at the moment, that may be an easier option than either the members contributing money as non-concessional contributions, or converting a related party loan to a contribution, so a non-concessional contribution, as you're able to do. Then, yeah, so it might be easier to actually basically wear the tax than it would be to make those non-concessional contributions. Because once that test essentially is a year-by-year test, so once you satisfy the requirements and either the loan's paid out or whatever it may be, then that is when you can either sell the property, realise capital gains, that sort of thing. So although this is, I suppose, been made out of recent times to be really a big, bad, scary, ugly thing, it may actually not be that bad. The trick is going to be, however, to make sure that any new arrangements that are entered into, that you do double check the safe harbour requirements to make sure that you're satisfying them. If you're not, then basically the trustees can't be assured that the ATO won't consider the arrangement to be non-arm's length dealings. That doesn't mean that it's not an arm's length terms, it just means that you actually have to prove it. So there's no certainty provided under these guidelines. So basically you need to be able to otherwise demonstrate that the LRBA is maintained on commercial arm's length terms or dealings. So that might mean obtaining evidence, so say getting an offer from a bank to say, okay, what would you provide, what terms would you provide if I were to borrow money from you, given this situation? Get that in writing and then replicate that outside. That's the easiest way to think of it. Now, there may be other situations where the client is happy to push the boundaries, so to speak. The challenge is always going to be that the tax agent and the auditor need to agree that the dealings are on an arm's length arrangement. that will only be an issue from a tax office point of view if either the tax agent and the auditor don't agree, and then the tax office will basically audit the fund and review it, or if they perceive if the tax office perceive that something else is going on and they undertake an audit of the fund. So really the first hurdle for any trustee is the tax agent and the auditor. From there, then you run the gauntlet, if you like, of dealing with the tax office. Remembering too that if the tax office deem you as non-arm's length income, they will issue an amended assessment going back to when they consider that arrangement occurred, and will also charge interest and penalties. So it could be rather expensive to try and ignore it, if I can say that. And as I mentioned earlier, any NALI income is basically taxed at top marginal tax rate, even if the fund is in pension phase. So you can't consider the fact that, well, I'm paying no income tax because I'm in pension phase, so therefore I don't care about this. Because unfortunately, NALI does not apply to the current exempt pension income calculation. That is something I expect the tax office to really hone in on, as I mentioned before, with their compliance hit list. Another thing that's sort of reared up in of recent times is I suppose the ability, if I can say that, for transition to retirement income streams to be pension payments to be treated as lump sums. So a little bit of history. A private binding ruling was obtained by actually a firm here in Brisbane late last year, asking if a TRIS payment could be considered as a lump sum for tax purposes. Now, remembering that TRISs are a non-commutable pension, so that means they can't actually be converted to a lump sum. However, the tax office actually said yes, a TRIS payment can be considered a lump sum for tax purposes. Now, I'll be honest, I actually found this quite surprising, because typically transition retirement income streams are paid from preserved benefits. So if they're paid from preserved benefits, it means that you can't actually otherwise access them unless you meet what is called a nil condition cashing condition. So to me, it was a little bit surprising, if I can say that. So then it became a little bit of marketing hysteria around this. So the ATO said that, look, that's fine, but everyone has to get their own ruling to make sure that they're safe harboured, basically. Then I think the ATO got swamped with all these private binding rulings essentially asking the same question. So recently, the ATO published some information on their website saying that in certain circumstances, a member can elect, under the income tax assessment regulations, to treat a TRIS payment as a lump sum and therefore access the low rate cap. So the low rate cap is an ability from where you can receive money from superannuation up to $195,000 for the 2016 financial year without paying any tax. So that's why people are keen to do it, where otherwise a TRIS pension payment would be taxed at normal marginal tax rates, less a 15% offset. Now, a couple of important things to bear in mind with this is that the member has to actually make the election before the payment is made. Also, the ATO have said that there are a number of considerations of treating a TRIS payment as a lump sum for income tax purposes that have to be taken into account. So firstly, you still have to comply with the TRIS requirement of meeting the 10% annual limit. So that still applies. As the TRIS payment is not a lump sum for super law purposes, it cannot be paid as an in specie asset. So in other words, it has to be paid in cash. So for some of you who may know, pensions have to be paid in cash. You can't do it as an in specie transfer. Lump sums you can, however, do as an in specie transfer. So this is basically just reminding everyone that you still have to do cash. It may also affect the amount of the super fund's exempt current pension income, as this only applies where the assets are supporting a pension. Now, we're actually having some discussion at office earlier as to, while the tax office have made that statement, technically it's a challenge to see how they can get that link to work. So I'm wondering whether this is them basically throwing a bit of hot air around to try and scare people away from doing this. And another colleague of mine actually made the point that the normal process that as an accountant you would go through is that you ask the actuary for the exempt current pension income percentage. So is that then throwing an onus back onto the actuary? And how does that work? Because currently they don't ask for enough information. So will that change it from their point of view? Who knows? And the tax office said it will also affect tax offsets to the payment. Just quickly, because I am a little bit of a super nerd, on the 9th of March 2016, Treasury released a discussion paper looking to enshrine the objective of superannuation into legislation. The theory behind this, according to the Assistant Treasurer, was that enshrining the objective of the superannuation system in legislation will provide guidance to the policymakers, regulators, industry and community about the fundamental purpose of super. So really they're trying to set a parameter or a baseline as to how changes in superannuation should be made or why they should be made, to try and move away from this notion of super as being basically a vehicle in which that governments can use as a tax way to alleviate the budget via the tax measures. Now, the Chief Executive of the SMSFA has also said that this objectives will influence policy areas for not only super but also tax, social security, health and ageing. And as such, it should be in standalone legislation rather than buried inside the SIS Act or the ITAA. So who knows where this will go, or will it actually achieve anything? My gut feel is that it's a nicety, but it won't really do much. But I'm happy to be proven wrong. Just quickly on the rates and thresholds for 2017 as they currently stand. I emphasise that with the utmost vigorousness. So basically concessional caps and non-concessional caps are all staying the same. Capital gains tax cap amount is increasing a little bit and the low cap rate stays the same as well. And finally, I want to round out with some budget speculation because there's nothing like throwing a bit of scuttlebutt around. Now, I emphasised before on the previous slide about the concessional caps and how they are as they are at the moment. So this is a list of some ideas that are kicking around within the industry, and I've also then sort of stamped them as the likelihood of them getting up and changing. So low contribution caps, so changing the concessional contribution caps from 30 or 35,000 down to another number. 20,000 is being thrown around quite vigorously, and the government has not backed away from that or even commented on that. That to me means that it is highly likely that we will see a decrease in the concessional contribution caps. Personally, I'm really surprised at that. I didn't actually believe a coalition government would take that stance, but it appears that they are. And personally, I think that's more of a political situation because that way they can say that we're not all about the big end of town. We're also about the workers. I don't believe it will go as low as what the Grantham Institute have suggested, which is 11,000. Now, what's interesting with this is that non-concessional caps are currently linked to the concessional cap. So it's 6 times. So 30,000 times 6, $180,000. Times that by 3 for the bring forward. Now, if this drops to 20,000, then that means that the concessional cap will change to 120,000, which means that the bring forward will drop to 360,000. So that's essentially a $180,000 drop in the bring forward. So whether they change that up or not, who knows, but it will actually require more legislation to get passed in what is an otherwise aggressive Senate. So I don't believe that they will change the non-concessional cap, but they will change the concessional. Div 293 tax. So basically this is where taxpayers who currently earn more than $300,000 are taxed an extra 15% on their contributions. And it's based on what I like to call an adjusted taxable income, that $300,000. I believe that that threshold will drop to $180,000, so it's in line with the top marginal tax rate. That will obviously capture a lot more taxpayers and will raise some more revenue for the government. Progressive tax on super. Basically, a little bit of history is that the Henry Review back in 2010 said that taxpayers should pay tax on their super contributions at marginal rates less 15%. Now, a couple of months ago, I was quite keen on this actually getting up. I shouldn't say keen, but I suspected it would happen. I'm waning from that because the larger end of town are saying it's all too hard for them. Self-managed super funds, it's quite easy, but for the bigger end of town, it is not. So I actually think that this may come away. However, they still could do it in similar veins as what they do with the current Div 293 arrangements. So in other words, once everything has been submitted, the tax office then essentially issue an amended assessment to say, here's some more tax to pay. Now, so the mechanism's already there for them to undertake this arrangement. Once again, death tax I was quite, I thought may actually occur, sort of waning a little bit on that. So currently, death of a member where their benefits are paid to a non-dependent, in other words, an adult child for argument's sake, is currently taxed at 15% plus Medicare. Now, I thought that they may look at removing the, and that's only on their taxable element within inside the super fund, because every member has a tax element and a tax-free element. I actually thought they may, on death, ignore the tax-free element so that everything on death becomes taxed. It's still possible, but I don't know if they're going to do it just at the moment. That may be a little bit politically too sensitive to do. Change to the TRIS criteria. Look, I don't believe they will do this. I think it'll be a little bit too hard to do, particularly given that a lot of the TRIS strategies going around revolving salary sacrifice or by employees that, I don't know, under $80,000 tax bracket, I think it was. And the only way that I could see them doing it would be actually adding a work test type arrangement to be eligible to start a TRIS. So currently over 65, you have to be working more than 40 hours in 30 consecutive days. They could potentially do a reverse where for it to be eligible for a TRIS, you can only be working for, say, 100 hours in 30 consecutive days. Who knows? So it's possible, but I don't think it will happen. And highly unlikely is the lifetime superannuation balance cap. As they say, the more things change, the more they stay the same. This is how the system used to work pre-2007. Back then it was known as a reasonable benefit limit. There's talks about it being a $2.5 million lifetime threshold and different numbers like that. I don't think that'll happen. It didn't really work that well back before 2007. I don't really think it'll work that well now. So don't expect that one. And finally, bang on time, upcoming webinars for in the next couple of weeks. So in 2 weeks' time, we have on April 27, Mark Alara doing an investment market update. So essentially talking about how all the companies following the reporting season have come out. And then the interesting one, Wednesday the 4th of May, the day after budget night, where myself and Kim Reynolds, the director of our tax consulting area, will undertake a review of the budget and essentially what that means for you and your clients as applicable. So with that, as we are right on time, I will sign off. So it's thank you from myself and thank you from Katrina. And until next time, appreciate you joining us.
Thank you.